Hello students who are taking Math for Business and Finance and Math Applications. This here is the video, the beginning video for Chapter 12, Compound Interest and Present Value. I don't know how many videos this is going to take for the theory portion of this particular chapter, but I know it's going to be at least 2. So let's just get started with this. All right. And before I do, of course, pause and rewind the videos if you don't understand something. Watch them a few times, and if you still don't understand, feel free to telephone and speak with an instructor or contact us via email. Okay? All right, so let's move on to Chapter 12 here. All right, let's see here. Change slides, and let me get my pen. All right, in this chapter, as you saw, it's about compound interest and present value. But I want to make a distinction here because in the previous chapter, Chapter 11, we were talking about simple interest. Okay? Well, actually, Chapter 10 and 11. Chapter 10 was for simple interest, but Chapter 11 was simple interest in discounting. Okay? So kind of like, what's the difference between simple interest and compound interest? Well, the simple standard example is given. Let's say you deposit $1,000 into a bank account. Let's just say that's January 1st. Okay, and let's say, to keep numbers simple, it's at 10% interest for the year. Okay. So over the course of 1 year, when it gets to be December 31st, you at $1,000 at 10% is $100. Okay, so you would have had gotten $100 in interest. So now your bank account would show $1,100 in it. Okay. Now, remember, this is you had put $1,000 in principal in that. Okay, and this here would be year 1. In year 2, you would again only get $100 in interest. All right, because it's based upon the principal that you had put in, the $1,000. Okay, so at the end of year 2, you would have $1,200 in the account. Right? And you would go so on and so forth. Now, the thing about compound interest is just that. It's interest on interest. Right? So if you put $1,000 into the account at 10%, and at the end of the first year, all right, you would get $100 in interest, and now you'd have $1,100 in the account, the same as simple interest. But here's where the compounding effect comes in, because now, instead of getting, as with simple interest, you're getting interest only on the principal. Okay, here, when you do compounding, you're getting interest on interest. All right, so for year 2, you're getting interest on the $1,100. You're not getting interest on the $1,000. So you'd have to multiply the $1,100 by 10%, and so that would be $110 of interest. Okay, so you would have $1,100 as the balance, and you would receive $110 in interest. Okay, so now you would end up with $1,210 in your account versus the $1,200. So you made like $10 more because of the 10% interest. And it's not, the idea, the concept is that you're getting the interest not only on your principal, but you're getting interest on the interest. And when you compound that, the compounding effect doesn't seem to take much at first, but then you reach a point where I like to call it like critical mass, where you hit a point right here, and now you start seeing, a mega effect take place. I mean, this first year, you say, oh, well, that's only like $10 extra, and the next year that's only like $20 extra. But you reach a point where you start to, the exponentiation of it begins to take effect, and the amount that you end up having in your account, grows. And the issue most people have is they can't wait until that point in time. Okay, they just, for whatever reason, they destroy. If they put this towards savings or some kind of investment, they can't wait for that 7, 8, 9, 10 years for it to, this growth effect to occur. They end up withdrawing from the account, and that just kills any of your chance at compounding. So that's the difference between simple interest and compound interest. And I could go on and on and on about the effects of compound interest and why I believe in it. But for this chapter, we're just going to stick to the plain underlying principles. How you apply that in your real life and what you actually do is a subject matter for a whole other videos. Okay, all right. So let's move on here now. You have to be aware of a concept, two other concepts also called lump sum and annuity, which is nothing more than payments. Okay, when we're looking at something, a lump sum is saying, okay, I'm going to put $1,000 into that savings account. That's a lump sum, right? And if I don't put any more into it, okay, then over time, that's going to compound, all right, and you end up with a dollar amount here. Okay, so you only put in 1,000, but down here you may end up with, let's just say, $2,100. Okay, you didn't put in any more money. You only put in that one lump sum, and you've collected your interest over that period of time, so that at the end of the investment period, all right, or the compounding period, you have a greater amount. Now, annuities are different. They're payments. And what that means is that you put in a specific amount. Let's say it's $100 in year one, okay? And then you'd get the interest on the $100, all right? And then year two, you'd put in an additional $100 as a payment. I use the word payment. It's called an annuity. But you have to think in terms of that payment. In other words, I put in the 100, then I have to pay another 100. I have to put in another 100, okay, and another 100. So that to think of it in terms of payments, over here with the lump sum, if I had year 10 and I ended up with $2,100, well, for 10 years over here underneath payments, under the annuities, I'd put the $100 in 10 times, right? And I would have invested $1,000, okay? Whereas over here, I also invested $1,000, but the difference being is how the money went in, because obviously over here, if we're at 10% interest, right? In year one, we would get $100, but over here, in year one, we're only getting $10, okay, of collecting interest, right? So there's pros and cons to both, and that will lead into what's called present value and future value. Now, before I go into present value and future value, though, understand that right now we're going to pretty much be talking about lump sum in this chapter. In a future chapter, we're going to talk about annuities and deal with those in that respect. I believe it's actually the next chapter, chapter 13. Yeah, chapter 13. We deal with annuities. So in this chapter, we're going to kind of stick to compound interest using a lump sum. But in thinking from that perspective, so we have compound interest, and we're thinking about lump sum, meaning we invest one time whatever amount. Okay, it could be 2,000, it could be 32,000. It doesn't matter. It's a lump sum. Right? We have two different concepts that we have to think about: present value and future value. And the way to think about that is, let's draw a timeline here. Okay. This is today, and this is, sometime in the future. Okay. if we invest an amount today and we get interest, a percentage in interest over time, okay, we can figure out how much that is in the future, and that's called our future value. Okay. Now, the reverse is true also. We can say, okay, and I'm just going to make something up here. Let's say we're investing $1,000 today. Okay. And again, this is just made up. And for whatever period of time, at whatever percent interest, in the future, we're going to say that this now is worth $3,200. Okay, that's the future value. Right? We can do the same thing, but in reverse. We can say, okay, here's a future value amount that I want. Okay, I need $3,200. How much would I have to put in today, right? How much would I have to put in today in order to get that $3,200? So we can actually work in reverse. We could say, okay, we have a future amount, but I want to know what the present value is. I need to know how much it is, worth today. Okay, and this, think along the lines of maybe, as an example, child's education. You want to pay for college. Okay. Let me erase some of this here just to give it a little bit clearer example. Okay, actually, let me just erase a lot of it. Or I'm just going to erase all of it. Okay, so anyway, let's say you know that your child is born today. Okay, and you know that 18 years down the road, okay, you want to be able to pay for your child's education. Okay. And you kind of figure that the education is going to cost $60,000. Well, that's a future value, okay? And you want to know how much today. Well, you have to take into consideration, okay, this here time frame is 18 years, so that's time. You want to know how much the amount is, right? But we also have to figure out, our interest, our percent interest. Well, how much interest are you going to get in a bank? Right now you're getting like, 1/4%. All right. Let's say you're able to invest the money a little bit more wisely. You're actually able to get 8% interest. Okay. Well, because you know the future value, you know the interest, and you know how many years, you can work it backwards and figure out how much that amount you need in order to be able to, if you put it in as a lump sum today, okay, a lump sum today, maybe you only need to put in $10,000. I'm just guessing at that number. I really don't know. All right, but you would put in $10,000, and if you left it there, invested at 8% interest for 18 years, you would have the $60,000 that you need in order to pay for the college education. Okay. Now, I had just said lump sum. Okay. Again, in Chapter 13, we're also going to talk about annuities, which are payments. Okay, so maybe I don't have 10,000 as a lump sum, all right, but maybe I could invest $1,000 each year, okay, because let's say I would use my income tax refund, okay. Every year I get my income tax and I take a portion of that and I stick it in. Well, again, using an annuity, I mean, we know what our future value is going to be, and we know that it's going to be over 18 years, and we know that we can invest at 8%, and we know that we can put in $1,000 each year. We can work backwards and say, okay, well, maybe I need 1,000, maybe I only need $720 each year to invest each and every year, okay, as a payment, in order to be able to arrive at that $60,000. Okay, so that's kind of the difference between a lump sum and an annuity. And again, we're going to go into that in annuities in Chapter 13. But for now, I hope you understand the difference between the present value and future value. And I'm going to stop with this video and pick up in the next one. Okay?